Let's forget about the daily price charts for just 1 second. Forget about the latest meme coin that's doing 1000x. Let's focus on what's really happening behind the scenes. The most inevitable and frankly the most ironic story in crypto right now is happening almost completely under the radar. It's not about a single company making a splashy purchase. It's not the revolution you were waiting for. The real story is quieter. It runs deeper and it has massive implications for the future of this space. It's about a fundamental co-opting of the global financial system, with Ethereum right at the center of it. The same institutions that spent a decade calling this a scam aren't just looking at Ethereum anymore. They are actively building their new empires on top of it. Everyone is waiting for that MicroStrategy moment for ETH, but they're looking in the completely wrong direction. They're waiting for a press release for some Wall Street CEO to put on a laser-eyed profile picture, but the real moment is already here. It's a quiet, systematic colonialization that's creating the perfect storm for a supply squeeze that could catch everyone by surprise. Let me show you what I mean. What if I told you that the MicroStrategy moment for Ethereum isn't going to be a carbon copy of Bitcoin's? It's going to be completely different and in a way far more insidious, okay? We all remember what happened with Bitcoin. Back in August 2020, MicroStrategy led by Michael Saylor started converting huge chunks of their corporate treasury into Bitcoin. That one move was the spark that lit the institutional fuse. It gave other CEOs and boardrooms the compliance-friendly playbook they needed to even think about putting Bitcoin on their balance sheets. It was a massive vote of confidence that echoed across Wall Street, and it kicked off a supply shock as billions of dollars from the old world started chasing a very limited number of coins. Now, the whole market is waiting for that same domino to fall on Ethereum. They're scanning the headlines, waiting for that announcement. Major public company adds $500 million of ETH to its treasury. And yes, we've started to see the first signs. A company called Bitmine Immersion Technologies recently announced a $250 million ETH treasury strategy, explicitly following MicroStrategy's model. This is the first domino. It's a big deal, but if you're only watching for these kinds of announcements, you are missing the hostile takeover happening right under your feet, guys. Ethereum's real institutional moment isn't about one company buying it as passive store of value. It's about the entire global financial industry starting to colonize it as an active foundational layer of their same old games, just on new rails. This isn't about decentralization, guys. It's about utility that can be exploited. And the slow, methodical integration is creating a supply and demand setup that could be way more powerful than anything we saw with Bitcoin. The evidence for this silent takeover isn't in one explosive headline, but in a series of calculated moves by the usual suspects in finance. These aren't innovative bets, all right? This is the construction of a new financial plumbing. And Ethereum is the pipe they decided to use. Let's start with the prime example. BlackRock, the world's largest asset manager with trillions of dollars under its control, isn't just playing around with ETH ETFs. They've gone a huge step forward. In March 2024, they launched the BlackRock USD Institutional Digital Liquidity Fund, or BUILD. This isn't just some fund that holds crypto. It's a fund that lives on the Ethereum blockchain. BUIDL isn't a tokenized money market fund. It represents ownership of real-world assets, cash US Treasury bills, as a digital token on Ethereum. Think about the irony here. BlackRock, the epitome of the centralized system crypto was built to oppose, chose Ethereum to build their next generation financial products. This isn't a passive investment. It's an active integration. It's a sign to the rest of Wall Street that Ethereum is no longer a fringe asset to be dismissed. It's a stable, reliable, and secure pure utility to be exploited. And BlackRock is far from alone. We've seen a huge wave of so-called real-world assets, or RWA tokenization. This is just a fancy way of saying they're putting their traditional assets on chain, and Ethereum is the clear winner for where they want to do it. Then you have the banking giants. Deutsche Bank is actively building on Ethereum. They're working on their own project, DAMA2, using Ethereum's tech to create a platform for asset managers. They've already experimented with issuing tokenized bonds for huge companies like Siemens. Sabi Benzad, who heads up digital assets at Deutsche Bank, said they have been experimenting to death with this tech, moving into real-world applications. You see this trend everywhere. At recent crypto conferences, the institutional presence is, quite frankly, overwhelming. The wolves are at the door, dressed in suits from BlackRock, Deutsche Bank, Coinbase, and Kraken, talking about building on the network. All right, we've all heard that before. Now, this is the real MicroStrategy moment. It's not one company, it's an entire industry. They aren't just building ETH and holding it. They are weaving it into the fabrics of their own operation, making it a critical part of their future dominance. So why is this kind of adoption so much more impactful on the market than a company just holding ETH for its treasury? Because it creates a multi-stage economic rocket that fuels demand and constricts supply in a way that is structural and self-perpetuating. The first stage is the most basic, ETH as a commodity. It's every single thing that happens on the Ethereum network requires a transaction fee paid in ETH, and we call this gas. When BlackRock's BULLISH fund issues new shares, that's a transaction and it costs gas. When an investor moves those tokens, that costs gas. When Deutsche Bank settles a bond, they need gas. Every single one of these institution use cases forces them to pay a toll on the network called gas. This creates demand that has nothing to do with price speculation. It's pure utility-driven demand. The more economic activity they move onto Ethereum, the more gas is needed. This turns ETH from just an investment into the digital oil that powers their new machine. As they project tokenizations in the trillions of dollars in assets, the demand for this digital oil is set to explode. This isn't just a one-time purchase, guys. This is a constant, never-ending buying pressure tied directly to their use of the network. You know, it makes me think, no wonder these guys made everybody start hating on ETH. They don't do their homework, do they? The second stage is what makes Ethereum so irresistible to a corporate treasurer or fund manager. It has a native yield. Unlike Bitcoin, Ethereum can be staked. You lock up your ETH to help secure the network, and for doing that, you get rewarded with more ETH. As of mid-2025, that yield is around 3 to 4% a year. This is a complete game changer for a Wall Street mindset. A corporate treasurer wants their capital to be productive. Holding cash loses to inflation. Gold or Bitcoin rely on price appreciation, but with Ethereum, an institution can hold a strategic asset that also generates a steady return. Suddenly, to them, ETH isn't just magic internet money, it's a yield-bearing asset. It's like a decentralized government bond, and it makes ETH an incredibly attractive asset to have on a balance sheet. It's not just sitting there, it's working for them. This is a huge reason the available supply is shrinking a lot. The incentive to stake is so strong that of mid-2025, over 35 million ETH, close to 30% of the entire supply, has been locked away in staking contracts. These coins aren't on the market. They're busy securing the network and earning yield, effectively pulled from the liquidity supply. The third and final stage is the powerful economic loop created by EIP 1559. As we said, every transaction has a base fee paid in ETH. EIP 1559 introduced a mechanism to burn or permanently destroy that base fee. It's gone. Now, connect the dots. Stage 1, institutional use of the network goes up, more transactions. Stage 3, more transactions means more ETH getting burned every single day. At the same time, new ETH is created to reward stakers. The magic happens when the amount of ETH being burned from all those transaction fees is greater than the new ETH being paid out. When that happens, Ethereum becomes deflationary. The total supply actually goes down. So let's pull this all together. We have a triple powered engine creating a massive supply squeeze. You have real utility driven demand from institutions that are forced to buy ETH for gas. You have a massive incentive for anyone to lock up their ETH to earn yield with almost a third of the supply staked. And you have a mechanism that actively burns supply as the network gets used more, even by its ideological opponents. More demand, less supply, and a potentially decreasing total supply is the perfect storm here. This is a deep structural shift that goes way beyond the daily noise. If you're finding this analysis useful and want to stay ahead of the real trends shaping crypto's future, take a second to hit that like button and subscribe to this channel. It tells the algorithm that this is the kind of deep dive content people want to see. Now, let's talk about why this is all happening so quietly. This brings us back to the title, why is no one watching? If this institutional rewiring is so huge, why isn't it the lead story on every financial news network? The answer is in the nature of the story itself. The market loves simple, punchy narratives. CEO buys billions of Bitcoin in crypto. It's an easy story to tell. It's pretty childish, whatever. I don't care about it. It's dramatic. It has a clear hero and it fits the headline. The real story of Ethereum's adoption is the opposite. It's complex, nuanced, and spread out. It's not about one hero, it's about hundreds of risk-averse centralized institutions all making the same calculated move to co-opt a decentralized system. A headline that reads, Deutsche Bank successfully tests compliance tokenization framework on Ethereum is way less sexy, but it's infinitely more successful for a long-term state of network. This accumulation is silent because it's an invasion happening in the plumbing. It's in the back-end systems of the bank and asset managers. It's in the regulatory filings for new tokenized funds. And do not forget, Ethereum is host to most of the stablecoins, which are about to be pushed on everyone with the same programmability as CBDCs. The irony here is that even Vitalik Buterin has pointed out institutions are drawn to Ethereum not for the hype, but for the very thing the core community has valued all along: stability, reliability, and the fact that it does not go down like Solana. These are not qualities that make for explosive news, but they are the exact qualities you need if you want to become a settlement layer for the global economy. The supply is also being soaked up in a less obvious way. The ETH being taken off the market isn't going to one company's public wallet. It's being locked up into thousands of different staking contracts. The supply on exchanges has been hitting multi-year lows, a clear sign that coins are being moved into long-term wallets for holding and staking away from the speculative frenzy. The steady drain doesn't create one big price spike. It creates a slow tightening pressure that builds over time. People are watching for a tidal wave, but what's really happening is the sea level is slowly and permanently rising. By the time most people realize how high the water is, the entire landscape will have already changed. Let's bring this all together. What we're watching is not some wild prediction. It's a description of market forces that are already in motion. First, the definition of MicroStrategy moment has changed for Ethereum Ethereum, it's not a copy and paste of Bitcoin's story. It's a story co-opting based on Ethereum's unique strength as a programmable, productive asset. Second, the proof is in plain sight. The world's biggest financial institutions like BlackRock and Deutsche Bank are not just dipping their toes in, they are planting their flag and building the same old systems on top of Ethereum's rails. The question isn't if anymore, it's how fast. Third, the engine for a supply shock is way more powerful and has hidden layers more than just a corporate buying spree. It's a trifecta of a growing non-speculative need for ETH as a tool to power a tokenized economy, a strong incentive to stake ETH and earn yield, taking it off the market. We're talking over 35 million ETH already. A burn mechanism that reduces the total supply as network use goes up. This is the perfect storm. A growing real-world demand is slamming into a rapidly shrinking supply. The amount of ETH on exchanges is at its lowest it's been in years, which has historically come right before major price moves, which we're seeing right now. While most of the market is looking for a single loud signal, the institutional money is moving quietly. They see ETH not as a revolution, but as a resource to be exploited, plugging it into their foundation of their existing empires. They're building the highways for the next wave of capital on their terms, not yours. So while everyone's watching the front door of a Michael Saylor type figure to make a grand entrance, the real institutional adoption is sneaking in through the side door, the back door, and the right up to through the foundation of the building. The MicroStrategy moment for Ethereum isn't one single announcement. It's the slow and undeniable process of being colonized as the global settlement layer for a tokenized world. The story is changing from digital gold to digital oil and digital bonds, all rolled into one asset. It's not about one company adding ETH to a spreadsheet, it's about the global financial industry taking this asset and building their own for the future. The question is no longer if institutions will adopt Ethereum, but how much of the trillion-dollar global economy will eventually run through their walled gardens built on its tech. This is the story that almost no one is watching, and it just might be the most important one of the next market cycle. What do you think? Is the institutional invasion a net positive or the beginning of the end for this cypherpunk dream? Are there other signs of this silent takeover that I missed? Let me know through your comments below. And if you want to stay ahead of these deep structural trends that most of the market is missing, make sure you subscribe with that notification on. Thanks for watching. Talk to you guys soon.